wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 220, and in this episode we're reviewing the performance of the financial markets during the 27th week of 2026, and that is from Monday the 6th to Friday the 10th of July. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off with the IMF, where according to the latest World Economic Outlook data, July 2026, the International Monetary Fund projects that global economic growth will moderate to 3% in 2026, which is a slight downgrade from the earlier projections and a decline from the 3.5% in 2025. The slowdown in economic growth is mainly attributed to the conflict in the Middle East and the impact of higher energy prices, with global inflation now projected to rise to 4.7% in 2026. Over to the United States, where on Wall Street last week, the S&P 500 rose on Friday to record a weekly gain, bolstered by the performance of a couple of big tech stocks. The broad market S&P 500 recorded an advance of more than 1% for the week to end at 7,575, and the tech-heavy Nasdaq Composite notched a gain of more than 1% to close at 26,281, and the 30-stock Dow Jones Industrial Average was the contrarian for the week as it fell by 0.5% to settle at 52,637. The divergence between stocks and the U.S. economy, where most of the time the stock market and the economy tend to move in tandem, but sometimes they can deviate quite significantly. This time around, the divergence can confidently be attributed to artificial intelligence. The stocks of AI companies have shot up sharply in 2026, and this has lifted the broader stock market. Reason being, the technology stocks now account for about 50% of the stock market's valuation. And given that stocks generally trade based on the future expectations of a company's performance, and in this current environment where investors are incredibly bullish on the earning potential of AI companies, it's therefore no surprise that stocks are rising while the US economy is slowing down. In the government bond market, Treasury yields were higher on Friday as investors monitored the latest developments in the Middle East after a U.S. official said it would continue to hold technical talks with Iran despite a flare-up in hostilities. With no major economic data releases expected on Friday, traders continue to watch events in the Middle East as renewed missile strikes between the U.S. and Iran has further strained the already fragile ceasefire agreement. The yield on the 2-year Treasury note, which typically moves in line with short-term Federal Reserve interest rate decisions, gained more than 4 basis points to close at 4.20%, whilst the yield on the 10-year Treasury bond, which is a main benchmark for mortgages, auto loans, and credit card debt, rose more than 2 basis points to settle at 4.56%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, oil prices fell on Friday but posted a weekly gain as renewed fighting between the US and Iran disrupted shipping in the Strait of Hormuz, stoking concerns over supply disruptions. On Friday, President Trump said that the United States and Iran had agreed to continue peace talks, but also confirmed in no uncertain terms that the ceasefire agreement was over. These developments have delayed the full reopening of the Strait of Hormuz, which carries about 20% of daily global oil and gas supplies. For the week, Brent crude gained by about 5% to close at $76 a barrel, whilst the U.S. benchmark, West Texas Intermediate crude, increased by about 4% to settle at $71.40 per barrel. And in related news, according to the International Energy Agency, global oil demand is said to decline for the first time since 2020 as the war against Iran continues to disrupt production and exports from the Middle East. In its latest oil market report released on Friday, the 10th of July, the IEA said that global oil demand is set to decline by 1 million barrels per day in 2026, which could mark the first annual decline since the height of the COVID-19 pandemic in 2020. In the precious metals market, gold eased on Friday and was on course for a weekly decline as higher oil prices linked to the Middle East conflict fueled inflation concerns and bolstered expectations of tighter U.S. monetary policy. The major factor here is the escalation of tensions between the US and Iran, with investors not in favor of holding either gold or silver at this point, which is why we've seen this move towards $4,100. Oil prices were also poised for a weekly rise, propelled by supply concerns amid the flare-up in the Middle East. Higher energy prices fuel inflation concerns, strengthening expectations of interest rate hikes by the major central banks. While gold is generally viewed as an inflation hedge, higher interest rates tend to weigh down on the non-yielding metal by increasing the appeal of interest-bearing assets. And in response to the foregoing, the price of spot gold slid nearly 1% on Friday to close at $4,071 per ounce. Up next is a quick review of the African financial markets, and we start with an announcement by the Dangote Group. The Dangote Group has announced that its proposed East African oil refinery will be built in Kenya rather than Tanzania, ending speculation over the location of the region's most ambitious energy project. The facility will have a processing capacity of 700,000 barrels of crude oil per day, making it the largest oil refinery in East Africa, and will supply refined petroleum products to Kenya and its neighboring countries to reduce regional dependence on imported fuels. A senior executive with the Dangote Group told Reuters that the plan to build the oil refinery in Kenya will be financed through internal cash flows, bonds, and an initial public offering, and is expected to take up to 3 years to build. And over to TZ, where On Friday, the 3rd of July, Tanzania's central bank raised its key policy rate by 50 basis points to 6.25% after inflation accelerated to its highest level in 3 years. The annual rate of consumer inflation for the month of May increased to 4.2%, up from 4% flat the previous month, and was driven by higher fuel and fertilizer costs linked to the war in Iran. However, inflation still remains within the central bank's target range of between 3 to 5%, but is now at its highest level since April 2023. Despite the impact of the Iran war, Tanzania's Monetary Policy Committee said that it was satisfied with the performance of the domestic economy, with growth for the first half of 2026 projected at 6% flat. We now change scene to the Kenyan financial markets, and we start by looking at Kenya's economic growth, where according to official data published by the Kenya National Bureau of Statistics on Friday, the Kenyan economy expanded by 5.3% in the first quarter of this year, and this was up from a growth of 4.9% for the same period last year. This latest report on Kenya's gross domestic product, which is a measure of monetary value of all the goods and services produced within the country, shows that all sectors of the economy posted positive growth, resulting in an overall expansion of 5.3%. This is the fastest GDP growth recorded since 2023, signaling that the economy is gathering pace after a period of sluggish performance that was attributed to unfavorable weather conditions, exchange rate pressures, and the high cost of living. In the domestic foreign exchange market, during the past week, the Kenyan shilling was trading sideways versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.22, and this is compared to a rate of 129.30 that was recorded the previous week. Meanwhile, the sterling pound was priced at 172.63, and the euro was valued at 147.26. And on the regional front, one Kenyan shilling was changing hands for 28.55 Ugandan shillings and 20.33 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.37. Despite the ongoing conflict in the Middle East and the subsequent increase in oil prices, the Kenyan shilling continues to remain extremely stable versus the US dollar. The data shows that the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. However, the central bank continues to insist that it operates a floating exchange rate policy with minimum interventions to smooth out extreme volatility. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased for the second week in a row, and this time by a comparatively modest $80 million for a grand total of $14.12 billion, which is equivalent to 6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024 with the maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the liquidity situation in the interbank market was sufficient to meet the demand for overnight lending and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka Kesonia, this is the rate that banks used to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the current central bank rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 30.4 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 9th of July, and the central bank received bids totaling to 49.7 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 177%. The central bank accepted 30.5 billion shillings, and the results of the auction were as follows. The 91-day rate slipped by about 1 basis point to come out at 8.82%, whilst the 182-day rate ticked up by 1 basis point to settle at 8.97%, and the 364-day rate remained unchanged for the third week in a row at 8.99%. Please note that over the past few weeks, the Treasury yield curve has been rising steadily, and this is on the back of increased government borrowing as the Treasury seeks to plug a budget deficit for the current fiscal year 2026-2027 that is estimated at about 1.2 trillion shillings. In addition to this, the latest data shows that inflation is trending higher, and this is mainly driven by rising fuel prices due to the ongoing conflict in the Middle East. And as a consequence, we should therefore expect more upward pressure on interest rates as investors demand higher yields in order to offset the impact of inflation. In the primary bond market, the Central Bank of Kenya held an auction on Wednesday, the 8th of July, for the 3 reopened fixed coupon treasury bonds, in which it was looking to raise a total of 70 billion shillings for the stated purpose of budgetary support. The central bank received bids totaling to a whopping 144.4 billion shillings, which represents a performance of about 206%. However, the central bank ended up accepting about 70.6 billion shillings, and the results of the auction were as follows. For the first bond, which is a 10-year bond that was initially issued in 2022 and now has 5.8 years left to maturity, the central bank accepted 51 billion shillings at a weighted average rate of 12.78%, and this is compared to the bond's coupon rate at 13.49%. And for the second bond, this is a 20-year bond that was initially issued in 2021 and now has 15.2 years left to maturity. The central bank accepted 13.5 billion shillings at a weighted average rate of 14.33% compared to the bond's coupon rate of 13.44%. And for the third bond, this is a 30-year bond that was initially issued this year in 2026 and now has 29.9 years left to maturity. The central bank accepted 6 billion shillings for this bond, and the weighted average rate came out at 14.61% compared to the bond's coupon rate of 12.50%. In the equity markets, the Nairobi Securities Exchange has reached its highest ever market capitalization of 3.8 trillion shillings, and this is up by 28% year to date as the 4 market benchmark indices climbed to new all-time highs. Kenya's capital markets is anchored on the NSC's continued commitment to build momentum, strengthen investor confidence, enhance market liquidity, and cement Kenya's position as Africa's premier investment destination. On Kenya's national debt, according to the latest data from the central bank, Kenya's national debt as at April 2026 stood at 12.85 trillion shillings, and this was divided between domestic debt, which stood at 7.18 trillion shillings, and foreign external debt that is valued at $43.89 billion, which is equivalent to 5.67 trillion shillings. A recent debt sustainability analysis described Kenya's debt as manageable, but also highlighted a high risk of debt distress. According to the budget for the financial year 2026-2027, about 48% of total expenditure, which is equivalent to 2.3 trillion shillings, has been designated for public debt servicing. Essentially, what that means is about 50% of the total budget is going directly towards debt repayment, tightening the fiscal space available for development and economic growth. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product. And given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue. And this week, we're looking at 2 issues. The first is the savings achieved from the restructuring of SGR loans. For the financial year ended June 2026, Kenya was able to save about 22 billion shillings in annual loan repayments after restructuring the debt for the standard gauge railway from a floating rate US dollar loan into a fixed rate facility domiciled in Chinese renminbi. Data from the National Treasury shows that Kenya paid out about 107 billion shillings to Chinese lenders in the year ended June 2026, and this was down from 129 billion shillings that was paid out the previous year. The reduction in debt service costs came after the Treasury was able to convert $3 denominated loans into Chinese renminbi, while at the same time extending the repayment period in order to reduce the annual repayment costs. The restructuring also involved changing the interest rate from a floating dollar rate linked to the secured overnight financing rate and replacing it with a fixed renminbi rate. This move will provide certainty for the country in terms of its debt repayment costs and shield it from an increase in US interest rates. And the second issue is a warning from the Capital Markets Authority to fund managers operating special funds. The Capital Markets Authority has warned fund managers who are operating special funds against unethical marketing, including the advertising of high returns, without providing sufficient information and disclosure to clients about the significant risks involved with special funds. According to an article appearing in the Business Daily, the markets regulator held a closed-door meeting with fund managers earlier this month to address concerns about unethical marketing, in particular the hiring of social media influencers to hype up investments in special funds. Special funds have exploded in popularity over the past 2 years, especially with retail investors, and now account for about 24% of the total value of collective investment schemes, and this was estimated at about 204 billion shillings as at the end of March 2026. Special funds are regulated collective investment schemes that potentially offer higher returns compared to the traditional money market funds. But in order to deliver higher returns, they invest in a wider range of assets, including higher risk instruments such as global equities and bonds, as well as currencies, commodities, and derivatives. These assets have the potential to generate higher returns, but on the flip side, they also carry significant risk, which exposes retail investors to the potential for significant losses. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color Podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color Podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, be so happy that when other people look at you, they become happy too. A quote by an unknown person. Think about it. Thank you, and God bless.